Did your property assessment notices just show up? And now you're wondering if your taxes are going to jump?
Every year we get the same question from homeowners. Why did my assessed value change? How is this calculated? And what am I actually going to owe? Most people don't really understand how Nevada property taxes work until their bill shows up and it surprises them.
Over the next few minutes, we're going to show you exactly how Douglas County property taxes are calculated, how the 3% and 8% caps work, and what you can do if you think your value is wrong.
My name is Jen Almeida, and this is my husband Nate, and we help homeowners and buyers in Douglas County make smart, informed decisions so there's no surprises once you close the deal. Property tax in Nevada is confusing because it's not based on one number. You have a taxable value, an assessed value, a tax rate, and then possible caps and abatements layered on top of that.
Most homeowners get their new assessment and just assume their taxes are going to go up. They panic and they just pay it.
But in Nevada, your tax bill is not directly tied to your taxable value. Thanks to the 2005 tax relief law, owner-occupied primary residents are capped at a maximum 3% increase per year, and most other properties are capped at 8% maximum regardless of how much the value changes. But there are some exceptions to these rates. So let me show you how this works here in Douglas County.
First, the assessor determines your taxable value based on recent sales or replacement costs of the property. The Nevada law requires your assessed value to be 35% of that taxable value. The taxable value is the cost of the land plus new replacement costs less depreciation. And then from here, this is how your property taxes are calculated. Nevada taxpayers will pay the lower of the assessed value times the rate of the last year's bill plus the cap rate. But let me have Jen break this down in English.
Let me give you an example of a scenario that we see here all the time play out. Let's say you bought your home a few years ago and last year your tax bill was $3,000. This year, the assessor increases your taxable value by $100,000 because prices went up in your neighborhood. Most people think, well, my value went up, so my taxes are going to explode too. But because you're an owner-occupied primary residence, the cap applies to what you paid last year, not to the new value. So instead of jumping thousands of dollars, your tax bill can only go up by a maximum of 3%.
Using this example means your new bill only increased $90, even though your home value increased dramatically. That cap is the reason many homeowners are still paying taxes based on much older, lower values. But there are some exceptions. And here is where some people get caught off guard. If this is new construction or brand new parcel, there is no cap in the first year. We've had buyers build a new home and then get their new tax bill and then call us to determine why it was so expensive. That first year sets your baseline, and then the cap starts protecting you in future years.
So let's talk about the installment dates. Taxes are paid in 4 installments: the 3rd Monday in August, the 1st Monday in October, the 1st Monday in January, and the 1st Monday in March. But what if you disagree with your taxable value? What do you do next? If you think your taxable value is too high, you can first contact the assessor's office. If you still disagree, you must file an appeal with the County Board of Equalization by January 15th.
Many homeowners qualify for exemptions who don't take advantage of them. Surviving spouses, veterans, disabled veterans, and blind individuals, which can also reduce your tax bill if you apply by June 1st. If you have any additional questions regarding Douglas County real estate, please give us a call.
And for more information on Douglas County real estate, you can follow us or look at our website.